Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It's Monday, Macro Monday. Let's take a look at the institutional crypto flows or lack thereof from James at CoinShares. James citing the US government quagmire and treasury prices, fueling inflows of 21 million. So the good news is we did have inflows. I don't necessarily agree with what he says here based on who's buying and selling, but I'll take it, right? It doesn't matter. We don't care. We don't care if it's some reflection of the moon. We found something in the James Webb Telescope. We looked in the Mariana Trench, like, it doesn't matter. We will take the flows no matter where they come from. If we dig a little deeper here, we've got outflows from the US, inflows from Germany and Canada by the looks of it. Most of the inflows from the week coming into Bitcoin, out of short Bitcoin. And Solana, of all things, getting a little bit of a bitteroony there, as evident by the price action last week. And breaking it down by country, again, inflows from Canada and Germany, outflows from the United States, inflows from Switzerland. So kind of a mixed bag globally, but we are seeing outflows in the United States. One interesting thing that you always have to keep in mind is if we're seeing mega dislocations in the S&P or the Treasury market or somewhere else, we may not see inflows initially into these products because collateral may be needed elsewhere, similar to 2008 and gold. So it's not always going to be one-to-one. Looking at gold right now, gold is melting down. Well, I don't even know what the melting point of gold is, but we're there. We're at the melting point of gold. So the question I always have when I see that is, are people bearish gold or are people selling off collateral to meet, margin requirements or something, right? I don't think it's quite that simple in this case, but it's always worth thinking about. So if individuals in the United States were worried about the US government shutdown or something, Treasury related, I would expect to see inflows in the United States. That's just my opinion, but we'll take it, right? Doesn't matter. One thing I forgot to mention yesterday was we had an inflow on the Tether Bitcoin wallet, which we think this is. I'll put this link in the description of the video if you want to track it. But you can see on the 30th, Sailor was the buyer on the 25th. But at the very least, we have inflows of this variety, right? Love it or hate it, don't care. Again, it is provable, it is on chain, and this will show up in Tether's next quarterly report. So if it doesn't, then we can say, you know what, this probably isn't their wallet. But if it does, it's pretty easy at this point to point to this wallet and say, yeah, it's them, right? These are the Sailor buys. Again, his last buy was the 25th of September. He's got another 500 million or something on standby here as dry powder to buy more BTC. So as muted as the institutional flows are, we do have some regular buyers, at the very least, with deep pockets. Now, as we all know, the ETH futures ETFs launched today, and this was as of a few hours ago into market open. They did see some volume. They didn't see maybe the volume people were expecting. I don't know. ETH down pretty big today. ETH BTC down pretty big as well. I think in the near term, a blend probably makes more sense for people who have no clue what any of this stuff is on the institutional side. Because again, with the story, with the narrative, you can go to them and say, look, you can get your crypto exposure with these two assets, whether it's 50-50, whether it's 80-20, whether it's whatever, doesn't matter, right? That probably is a safer sell than saying, hey, let me explain Ether. I know you might not know what Bitcoin is, but come look at this other highly experimental network, right, to them. So blending it might be an easier sell at the end of the day. We'll see. As Eric says, not a lot of volume here compared to the BITO launch. Admittedly, the BITO launch was when things were much more bullish in the ecosystem. We did have another announcement from Grayscale where they filed paperwork to convert ETH into an ETF as well, spot ETF. That's no surprise. I think the real cash cow is going to be spot ETH ETF with staking. That sounds like something that's, again, an easier sell. People can understand flows, yield. You can talk about total return because otherwise you're getting diluted if you're not staking. And ETFs are definitely the name of the game these days. Here's a look at the monthly ETF launches since 2010, and we continue to trend upwards as opposed to mutual funds or some other product. This seems to be the wrapper where products get launched. So that's where crypto wants to be. Crypto wants to be a part of that conversation. Bitcoin wants to be a part of that conversation. People know what ETFs are. People are comfortable with that. Yes, it's not Satoshi's Bitcoin, okay, but if we want the flows, big if, I know, because some people don't, okay, but if we want the flows, this is where we want to be, this is where we need to be. And you might hate product launches like this, but we kind of need to throw a bunch of stuff at the wall to see what sticks. You know, the BitO thing, clearly they almost have back to $1 billion in AUM again. So this is the kind of thing we need, okay? They're not all going to be amazing, they're not all going to survive, but we need to be a part of that ETF conversation if we want the institutional flows. Before I talk about rates and inflation, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with a link in the description of this video. And just looking at the UI here, Link, I think on everybody's radar, continues to be on my radar as well. Sold off quite nicely from the range high. No super surprise there. I mean, if anything, we're starting to see signs for potential continuation here. What I said yesterday on Link high time frames is it could continue to range for another 6 months, right? Until it breaks out, you can't say it's going to break out because it hasn't broken out for the past year and a half plus, regardless of what fundamental news you're going to throw at me, okay? Now we have had Adam and Eve type fractals before that haven't broken out, but the market certainly looks like we're getting closer. Just sorting by volume again, like I like to do. Looks like we've got stablecoin pairs at the top along with Bitcoin and ETH. Pretty large differential on the day between Bitcoin and ETH, again with ETH BTC being down 3% plus on the day. As far as major events this week, we've got some numbers that I'm sure people are going to overanalyze and talk about. Jolts on Tuesday, a bunch of Fed speakers throughout the week, and some employment numbers, but really the big one is Friday when we're talking about unemployment and wages. Those are going to be extremely important numbers relative to maybe some of these other important but not generally as important as employment, right? Looking at meeting probabilities for the Fed, probabilities continue to favor pausing for the indefinite future. Essentially, no big changes here. The U.S. government shutdown stuff doesn't look to have impacted anything too much. They basically kicked the can down the road in 45 days when they get to do it all over again. So hopefully they get their stuff sorted and don't need to do that. But we know them, and I find that probably unlikely. Inflation ticking down slightly on trueflation. Unless anything major changes, we're probably going to continue to ping pong between low twos, high twos on trueflation. We've got energy ticking up slightly. We've got housing numbers rolling through CPI. So the CPI is expected to hold flat while it's may come down slightly. This is the Fed nowcast in October. So still well above the Fed's target, but thus far it hasn't come roaring back. Now, one good data point we did have was PCE, personal consumer consumption expenditures, something like that. Came down quite a bit. This is always touted as the Fed's preferred inflation metric. So it is good to see this coming down, continuing to come down, trending lower. Powell will be happy with that, certainly. And again, this isn't screaming the Fed should raise. We may see changes in probabilities if inflation starts to poke up a little bit. We may see cuts starting to get priced in sooner than they are now. So that's something to watch for come Friday. But as we stand now, again, we're continuing to hold at this level until mid-year. Just talking about the consumer real quick before I talk about bonds. I continue to see weekly, these charts that are using kind of like lagging data that the consumer's tapped out. The consumer doesn't have any savings left. It's certainly probably the case on the lower end of the spectrum. On the higher end, I think there's still plenty of money. The richers are going to be okay. All right. It's everybody else on the lower end. One interesting data point regarding credit card spending that has declined quite a bit. And that's really no surprise logically considering what rates are at. And what we don't know here is this just people hitting their credit card limit, which is absolutely frightening? Or is this people actually pulling back, right, on spending? In any case, probably not a great sign for a bullish, healthy economy. And I thought it was interesting, another small data point, Singapore talking about stimmies, essentially. Fighting money with inflation, fighting inflation with money, however you want to think about that. So in the US, we probably aren't going to see this anytime super soon unless things absolutely fall apart and the wheels come off the wagon, but it is starting to happen elsewhere. Now looking at liquidity, money supply, fixed income, that sort of thing. If we look at the money supply, they have brought the money supply down dramatically, quickly, the fastest contraction since 1933. So yes, of course we felt that in crypto, right? Certainly 2022 was a hot mess, to say the least. My question now is, are they going to continue to contract the money supply? Are they going to be able to contract the money supply? Or are we going to start to veer towards the Singapore model where we're giving people stimmies again? I see a lot of people talking about the Fed balance sheet, maybe in a different way than this is depicted. If we look at the post-2020 stimmies, we're still at that level where we've been unable to kind of come back down. This is looking at the Fed balance sheet, the TGA, and reverse repo together. Yes, it's come down quite a bit, but we're still nowhere near the pre-pandemic levels. And again, the question is, how much can they actually contract this before something breaks? That's the first question. The other question people are asking is, why are the S&P and the NASDAQ where they are based on the liquidity metrics? You'd expect them to be down considerably. Some of that is the AI miracle, of course. Some of that is just maybe we've diverged, Unlikely that we won't snap back, but maybe we have diverged. And here's that chart looking at the S&P versus liquidity. This has been beaten to death. But no, it's not a one-to-one, but it's a general correlation here. And yes, there was a wide gap between where the S&P sits currently and that liquidity index, if you will, at least in the United States. This may be factoring in global liquidity, but I don't think global liquidity has popped up enough to even justify the S&P and NASDAQ gains. Looking at reverse repo, and again, you can think about this as some inert pile of money that is short-term, collecting yield that may eventually end up rotating into long-term treasuries. So it's kind of the driest of dry powder that needs an eventual home. Has come down quite a bit, still around 1.4 trillion in reverse repos. So that's the good news. The bad news is if this dries up completely and we're still issuing debt, that may push yields even further if nobody wants to buy them, right? If there's a supply-demand imbalance, or people assume there's going to be a debt spiral, yields would need to go up to continue to attract buyers. But thus far, it looks as though much of that has come from the reverse repo and not from the risk markets. Looking at weekly fixed income flows, I don't know what exactly this entails, if this entails short-term and long-term treasuries, but we do seem to have the first outflow, despite everyone being bullish on TLT and bullish on the bond market. We're not seeing that on flows. So this could be another problem where not only do we have a supply-demand imbalance, but we have people actively selling or needing to sell, which could also help to push rates even higher. So that's another scary thing to think about. And if we look at the average price of the bond market, ideally you're at a price of 1, you're at par or 100 or whatever it is here, right? There's some yield component that's built in here. So you're gaining value or rates are going down, right? But since 2022, these have continued to lose value. And this is, again, the risk-free rate of the world, the risk-free market of the world, realizing that, there's a duration risk here if rates go up super quickly, just as they have. So if you're holding these to maturity, no big deal. But if you're holding a 30-year bond to maturity and you need that collateral, you do have to sell at a loss. You have to sell at a pretty big loss for something that is supposedly a risk-free product, right? And here's that 25-plus year U.S. Treasury, ZROZ is the ticker. The drawdown has been quite something since 2020. And you may be thinking, well, this doesn't affect me, who cares? That's true, but the entire financial industry is focused on the 60-40 portfolio or the 70-30 portfolio where you're allocating between risk on and risk off. And if the risk off portion continues to lose value, that's a problem, especially if you're actually believing in this, the 60-40 and you're continuing to rebalance to make that 40%, you do have to sell the risk to buy the bond portion, right? So all sorts of bad reasons why going down at this rate continuously is not great. And this from Charlie, started the drawdown in August 2020, 38 months, the longest drawdown on record, essentially, and a massive drawdown again for something that's supposed to be risk-free, that's supposed to be the sure bet, right? The sure bet is that these will be okay over the long term, but that certainly hasn't panned out as the 10-year yield keeps going higher. It looks like it's going to keep going higher. Almost looks like it's ready for a parabolic push higher, right? You can see the rate of change quickening as we've gone on here throughout the year, and just looking at this based on trend, using some basic TA, 5% looks very real based on the breakout. And as we see the dollar approaching 107 today, just ticking to 107 as I speak, rates likely to go higher, likely to continue to pressure equities markets, to continue to pressure banks. I'm looking at regional banks today, really taking a bath. The KRE regional banking index down almost 2.5%. Some regional banks down 3-4%. And if we look at the unrealized losses, they're still quite substantial, 600 million, right? We still have banks utilizing the BTFP to a pretty substantial degree. This has not been alleviated and likely won't be until yields come back down and this unrealized losses picture cleans itself up a bit. But this is not where you want to be if you're a bank, certainly. And luckily for the banks, the deposit outflow appears to have slowed in the moment, but it's not like it's safe completely because rates, again, probably go higher. The reason to get out of a bank savings account and into a money market account continue to grow by the day, and banks should continue to feel that, right? Not only that, again, if we're talking about risk versus risk-free, the 6-month Treasury bill yield is higher than the S&P yield, and we've talked about this for a couple of videos now. So there's just more and more reasons continuously to not be allocated into risk and to favor defensive short-term treasuries, okay? That's certainly where I'm living on my legacy stack. One odd thing though, and we've all felt this over the past month throughout September, oddly bullish for Bitcoin in September, breaking that seasonality, slightly bullish for ETH, later in the month with that ETF hype. But look at the negative picture on S&P, NASDAQ, gold, TLT, right? Now, this is a microcosm snapshot, right? Super zoomed in, but this could be the beginning of a story where the digital side takes over. Now, just as Bitcoin to ETH less so, but Bitcoin specifically is bullish Q4, as is this potato chart, showing the quarterly returns and the years with a positive return. So Q4 for legacy has been bullish historically, and it is the most bullish quarter, and it is one of the reasons why Bitcoin has been bullish historically as well. It certainly helped with the S&P. Now, the problem here is that just looking at this in the moment, first day of the new quarter, the S&P looks bearish, continues to look bearish, right? Yields going higher, dollar going higher, continuing to pressure the S&P. Things really don't get interesting until sub 4,200. Everyone's watching 4,200. Everyone's watching the 200-day moving average. Cloud told you to get out of this thing before September, okay? Chart pattern continues to tell you we're not there yet. And the cloud is telling you we've actually flipped bearish on trend with a full-blown bearish Kumo breakout. So I'm not seeing a lot of reasons to be bullish on the S&P. And a chart from TrendSpider, to me, kind of looks like bounce or die going back to October 2022. You can put that channel on the chart yourself and look for it. But if you're a bull in the near term, you say, okay, we're at the bottom of the channel. It's time to step in. Looking at what I believe he's got VPVR volume profile on here, to me it looks like there's no support, until the low 400s based on volume. He's also signaling oversold conditions on RSI. So there's certainly a bullish story you could weave here. I just am not a believer in the near term. And here are the cues looking significantly more neutral than the S&P, than the SPY, but certainly not bullish. We're not on trend bullish. There's still an active chart pattern that's playing out, still in the cloud, still nowhere near the initial AI mania breakout. And just as I kind of say on the chart here, my focus is going to be short-term treasuries here, not to try to find some sweet setup, okay? It's just, to me, it's not worth it. Because again, we have the dollar going to 107 plus at this point. And that's just going to continue to pressure everything. It's just breaking all TA as well, right? It's saying, what's TA as we go higher and higher and higher? Rising wedge, what's that? Oversold conditions, overbought conditions, what's that? Mean reversion, what's that? TKC clamp, what's that? This looks incredibly bullish as we're making multi-month highs on the DXY. Gold, again, selling off. Always interesting when you make some invisible line on a chart and the market knows it's there. But gold looks very bearish to me, undeniably breaking multi-month support. And with dollar strength, that's no surprise. With real yield strength, that's no surprise. So until any of that turns around, gold should continue to be weak. Silver, who trades this and why? I mean, it's down 10% in 2 days, 2 trading days. Just brutally ugly on silver. Breaking multi-month lows, breaking this inverted head and shoulders pattern. None of this looks pretty for silver. I know there's a lot of commodity bulls hoping that things explode and people flow into commodities, but not quite there yet. Before I go on to the single stock charts, I took a look at ARK because I saw somebody talking about the cloud, and their analysis based on the single cloud was this should be bearish, this should break down. I'm in agreement with that. This does look bearish to me. We're still below the weekly cloud. We're in this high volume important area, and they essentially said if this breaks 37, we're probably going to 22. I agree with that 100%, and I agree that's probably what's going to happen. However, one thing to consider here with something like ARK is the potential for this inverted head and shoulders setup along with an edge-to-edge move here. Now, I don't think this will play out, but it's important to consider the possibility here. There's probably a 10% chance in the moment that this happens, but if ARK starts to make slightly higher highs instead of lower lows below 37, sure. I like a massive move, basically a 2x, right, to 77. So this certainly leans bearish heavily. I don't think there's a specific trade here, but it's definitely something interesting to watch. And then the question for me is, do I even want to buy this at 22? I personally don't. I don't like the components, the constituents of ARK, but definitely something to watch as like a broader index of what's going on with retail money, liquidity. And I'm not going to say dumb money, but, you know, dumb money. Here's another thing that popped up over the past couple days. Marathon Digital Holdings as one of the stocks with the highest short interest, 31% of the float. So if things do go the other way for Mara, may push prices even higher with a significant short squeeze. But, you know, my guess is these shorts are probably pretty fat and happy and cozy considering miners are down around 50%. Just quickly going through the Elite 8. Some surprises here. So Apple bearish on trend. There is a bit of a bull div here from last week. You are getting a bearish Kumo twist, the first one since earlier in the year. So I don't think broadly this is bullish, but I do think we may get a decent bounce on Apple based on the divergence. I still think this is an avoid. I don't think for the most part any of these charts are inviting for the bulls just yet. Microsoft also below the cloud, bearish Kumo twist, not quite a bull div on that low either. So going forward, what you want to see on either of these is bullish Kumo breakout with price above cloud and a bullish TK cross, right? It's always the same thing, just like you had in the beginning of the rally, right? You also had an inverted head and shoulders to back you up on that with the confluence. And we may see that again. We may see an inverted head and shoulders with a neckline at 190. You can see half of it has basically formed here on Apple. But for me, I'm a buyer above the cloud, not below. So Microsoft also looking weak. NVIDIA, interestingly enough, has kind of saved itself in the cloud. Now you could trade this as a range from, let's say, 400 to 500. I personally don't think the risk reward is there. I think risk on this is massive. You did have a hidden bull div to kind of save you here. Momentum tried to pull this lower, but didn't. This isn't a pattern that typically resolves bullish anyway, and we can look to Amazon to see what I'm talking about. Rising broadening wedge, ascending broadening wedge, whatever you want to call it. These don't typically resolve bullish. Amazon also in the cloud, not, you know, on trend bullish at all. So not a whole lot of bullish vibes across the board there for the stocks that are basically leading the entire market and keeping the entire market afloat. Here's another interesting channel from TrendSpider, basically saying, look, this thing is cooked. It's probably reached its logical conclusion in the moment based on monthly candles and that lifetime channel. Now, Google looks much more bullish than any of the previous. It's still above the cloud. It had a decent key June bounce. I still think it has a rising wedge that is trying to break down from. And the other question you have to ask yourself is, as a group, if 5 of these start to drag down, are the other 3 going to be okay? Maybe on a relative value basis, but I think people start to get nervous if the other 5 start to drag down the group. This is Tesla, which in no way, shape, or form looks bullish to me. It looks neutral, looks ranging, looks double toppy. Maybe not as bearish as the first few, but doesn't look like anything like that I want to touch. Now, Meta may have a setup here because you're getting a bullish TK recross with price above cloud. So if anything on trend, this looks the most bullish to me, which is crazy to think. Something else to consider here is if they've got AI products or VR stuff actually coming online, maybe that's enough to push this thing for higher highs. But on trend, it certainly looks okay, and probably the strongest of the group. And then looking at Netflix complete mean reversion to the 200-day moving average, that head and shoulders has finally played out. Still not bullish by any stretch of the imagination, but there's a long way down here if the 200-day moving average does break and we get some real deal bearish momentum in the market. Lastly, I'll just talk about WGMI, which is the mining ETF. Has a weak bullish divergence, which tried to play out, a bit of a falling wedge, which tried to play out. It has a TKC clamp here. Now, my guess, I suspect, this thing's going to get mega oversold at some point, potentially to 570, which would be ugly. It's basically a 50% retracement thereabouts. From here, I'll take 650, basically this previous low. But this is basically at the mercy of crypto. So if crypto flips from neutral to extremely bearish, that's how WGMI gets to 570. Otherwise, it probably just ranges and chops around, maybe even continues to mean revert here. Certainly wouldn't expect anything to miraculously turn bullish anytime super soon. So kind of a mixed bag across the board. Jobs numbers big on Friday. Watch for yields, watch for the dollar, and watch for both of those to collectively just continue to pressure the risk markets. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.